Today, I'm going to show you a simple way to understand market movements using order blocks so you can trade with more confidence. Stay with me because this will change how you see the charts. Alright, let's get started. Before we get into trading them, let's first understand what order blocks are and why they matter. Most traders think they understand order blocks, but let me ask you this. If it were that simple, why do so many traders still lose? That's the big question, and I'm about to give you the real answer. Here's the truth. An order block is not just a random zone on the chart. It's a footprint left by institutions and smart money. These players don't trade like retail traders. They enter the market with massive capital, creating strong price movements that most traders don't even recognize. But here's where most traders go wrong. They see a big move, mark a box around it, and expect the price to magically respect it. The result? They keep getting stopped out, and that's a trap you want to avoid. So, what's the hidden truth? Order blocks only work because of how institutions place their orders. They don't just enter all at once, they scale in over time. When the price moves aggressively from a zone, it's often because smart money left unfilled orders behind. That's what makes it an order block. Now let's talk about the two types of order blocks you need to understand. First, we have bullish order blocks created by strong buying pressure. These typically signal that the market is about to move higher. Then we have bearish order blocks, formed by heavy selling pressure, signaling a potential downward move. Here's where it gets really interesting. Once an order block is identified, it becomes a key level. Smart money often returns to these areas before continuing their move. So, instead of chasing the market, you can wait for price to come back to these levels, enter at the right time, and ride the move with confidence. Now you might be wondering, do these order blocks really work in real-life trading? Let me show you. Imagine you spot a bullish order block. The price returns to it. You enter the trade just before the market explodes upward. And boom, you're riding a high-probability trade, just like the pros. This isn't just theory. This is how smart money operates, and I'll show you real examples to prove it. But here's where it gets tricky. Most traders think every order block is a good one, and they end up marking every zone they see, only to wonder why they're still losing. Not all order blocks are the same. Some are strong, and some are weak. If you don't know how to filter out the bad ones, you'll just be trading noise. So don't focus on every order block. Focus on the ones that actually matter. Now, let's talk about how to find the best order blocks. There are 3 simple rules you can follow to identify high-probability order blocks. By sticking to these rules, you'll be able to spot key institutional zones before the price moves, avoid fake setups that trap most traders, enter with confidence, knowing you're aligned with smart money. In the next steps, I'm going to break it down step by step, so you can start spotting these high-probability order blocks and use them to your advantage. Stay with me, because the next part is going to give you the edge you need to succeed. Let's start with the first rule. What if I told you the market isn't as random as it seems? Spotting inefficiencies is the first step to understanding smart money moves. Most traders think price movements are random, but here's the secret. Smart money leaves behind clues that can show you exactly where price might return. Imagine having the ability to spot these clues and use them to your advantage to make better trades. In the next steps, we'll dive deep into how smart money operates and how you can read the signs they leave behind. Stay tuned, because this could change the way you trade forever. Alright, let's break it down step by step. When you're looking at your charts, take a moment to spot those sharp, aggressive price moves, those quick jumps up or down with little to no wicks. These aren't just random price swings, they're the footprints of smart money at work. These moves reveal inefficiencies in the market, times when institutions push the price too fast, creating a gap. Here's the golden rule. The market often returns to fill these gaps before continuing in its original direction. That's why these inefficiencies are key to watch. They can show us where price might come back to. Now here's where a lot of traders get it wrong. They see a big move and jump straight in without asking why it happened. But here's what you should do. Step back and mark the last bearish candle before a strong bullish move, or the last bullish candle before a sharp drop. This is a potential order block, a level where institutions likely place their orders. But before you dive in, ask yourself, has the price already returned to this level? If it hasn't, the inefficiency is still there, and the order block is fresh. If it has, pay attention to how the price reacts. A strong bounce means smart money is still active, but if the price moves slowly through the level, it could mean the imbalance has been filled, making it less significant. Now let's go to the second rule. A lot of traders skip this crucial confirmation step and end up with weak setups that lead to losses. Don't be one of them. Always confirm your setup before jumping in. Let's break this down step by step. Identifying an order block is just the beginning. To truly maximize these setups, you need to confirm what the market is actually doing. How? By focusing on 2 key elements: break of structure and change of character. First, locate the most recent swing high or swing low near your order block. Then, watch how the price reacts. If the price breaks through this level with strong momentum, that's a break of structure, BOS. This signals that the trend could be shifting, making your order block a critical level to watch. So, always confirm the market's direction before taking a trade. This one step can be the difference between a high probability setup and a costly mistake. Now let's go to the third rule. Alright, let's break this down on the chart. Not all order blocks are created equal. Some are powerful, while others lose their strength over time. Now look at this first zone. This is a fresh, untouched order block, also called an unmitigated order block. Why is this important? Because institutional orders are still waiting to be filled here. This gives us the highest probability of a strong reaction when price comes back to this level. Now check this second order block. Price has already tapped into it, but it didn't break through, and we can see a strong bounce. This is a mitigated order block. Even though it has been tested, it's still valid as long as price continues to react here. Now, look at this last one. Price has slowly moved through the zone, and there's no strong reaction. What does that tell us? The institutional orders have likely already been filled, making this a fully mitigated order block. At this point, it's lost its significance, and we wouldn't expect price to respect it anymore. So, what's the key takeaway? Always prioritize fresh, unmitigated order blocks. These zones give you the clearest opportunity to trade alongside institutional orders and catch the best setups. Let's sharpen your strategy with a powerful bonus tip, combining order blocks with discount and premium zones for next level precision. Alright, let's break this down on the chart. First, we need to mark our range. We do this by identifying the most recent swing high and swing low. This helps us see where price is considered expensive, in the premium zone, and where it's cheap, in the discount zone. Now, let's apply the Fibonacci tool. In an uptrend, we draw it from swing low to swing high. In a downtrend, we draw it from swing high to swing low. The 50% level marks equilibrium. Everything below this is the discount zone, where buyers are more active, and everything above is the premium zone, where sellers take control. Now let's look at how this applies to order blocks. If we're trading a bullish order block, we wait for price to pull back into the discount zone, where smart money accumulates before pushing price higher. Here, we look for confirmations like rejection wicks, bullish engulfing candles, or increasing momentum. For a bearish order block, price will often retrace into the premium zone before continuing lower. This is where we look for signs of weakness, bearish rejection wicks, bearish engulfing candles, or slowing momentum, confirming that sellers are in control. The key takeaway? Not every order block is worth trading. By combining them with discount and premium zones, we filter out the weaker setups and focus only on high probability trades. Spotting an order block is just the first step. The real key is knowing how to trade them in live market conditions. Once we hit 30 likes, I'll drop the next video, breaking down 4 advanced strategies, including my favorite one that can help you make money. If we hit the goal, I'll show you everything step by step. Got questions? Drop them in the comments and I'll answer them in the next video. Let's make it happen.